Welcome to Chapter 3. What you'll notice as we go through Chapter 3 is a lot of the material that we previously learned is going to apply. The way this class works is you basically are building a foundation in the first couple of chapters, and we need to make sure that foundation is solid, because if not, as we build a house on top of it, everything is going to crumble if you do not have a solid foundation. The good news, though, is as we build that foundation, there's a lot of repetition, so hopefully as we go through the material in Chapter 3, it'll remind you of some of the concepts we've previously discussed and make the Chapter 3 concepts easier for you to deal with. So the first thing in Chapter 3 we're going to talk about is the business operating cycle and the necessity for the time period assumption. So you may remember in one of our previous chapters we discussed about the time period assumption and that time is infinite. But in order to prepare financial statements, we need to break up time into smaller, more manageable pieces like years, quarters, or months. So how do business activities affect the income statement? That's what we're going to focus on in this chapter. And how do we recognize the activities and how are they going to be reported on our income statement? So in Chapter 2, we focused on transactions that affected the balance sheet. Now we're going to focus on the income statement. The income statement tends to be a little more difficult for students because we're so set in our mentality that cash is everything that we sometimes forget the fundamental rules in accounting, which is that revenue is recognized when earned, not necessarily when cash changes hands, and expenses are recognized when used, not necessarily when paid. And that's difficult for new students to accounting because our focus is always on money. When do I get paid? When's my paycheck coming in? When do I have to pay out my bills? That's really our focus at the individual level, is money in, money out. But for a business, we're focusing on accrual basis, which is a function of when we earned the revenue and when we used the expense. So keep that in mind as we progress. The operating cycle for a business involves purchasing goods or services, a lot of times on credit, which means we'll pay for them later. And then once we purchase them, eventually we have to pay for them. Then we sell the goods or services to our customers. A lot of times that's done on credit as well, meaning the customers will pay us later. Then we finally receive the cash from our customers and start the cycle over again. The question becomes, during that cycle, when do we record the revenue and the expense? The time period assumption is the long life of a company can be broken up into shorter periods, and then that means that we have some issues. One is a recognition issue, which is when should the effects of operating activities be recognized or recorded? That's the whole concept of revenue being recognized when earned, expenses when used. That's the key. And then measurement issues would be what is the amount we need to recognize. As a general rule, that won't be very difficult for us to figure out, but it can be a little challenging at times when, for instance, we prepay an entire year's worth of rent and only 1 month goes by. We need to realize we don't recognize the expense for the entire year, only 1/12 of it for the monthly portion. So we'll be discussing that as well. So how do business activities affect the income statement? Well, we know the income statement from Chapter 1 is revenues minus expenses equals net income. We're going to expand that knowledge a little bit in this chapter. Revenues are the increases in assets or settlements of liabilities from our ongoing operations. What that means is revenues are going to result in either assets going up or liabilities going down. Revenues do not equal assets, my friends. They do not, and that's what students get confused a lot on. They go, oh, I earn money, it's an asset. Well, the cash is the asset, but the revenue itself is not. The way I like to explain this to students is to visualize a cash register. You go to the store and you make a purchase. The receipt is a record of the revenue the business has generated. It's just a piece of paper. It's a record of what's been earned. Then in turn, you give them money they put into the cash drawer, thus increasing their assets. So the asset is the cash in the cash drawer. The revenue is just a record of what's been earned. Another way to think of it is your W-2 if you ever had a job. At the end of the year, you get a W-2 and it tells you how much you've earned for the period of time, which is usually a year. But that doesn't mean you have that money anymore. You probably spent it. A nice weekend at Libby's. And you no longer have the same amount of assets. So revenues create assets, but they're not the same thing. Think of revenue as just that receipt. It's a record of what we've earned over time. How do revenues decrease liabilities? Well, if you remember back in Chapter 1, we talked about unearned revenue. When Southwest gets your money for an airline ticket, they owe you a flight. They have a liability. So when they fly you, they provide the good or service, they've earned the revenue, and then they don't owe you anymore, so their liability goes down. So again, revenue is a record of what's been earned by providing goods or services, and then that can either make assets go up or liabilities go down, but revenues are not synonymous with assets or liabilities. Likewise, expenses decrease assets or increase liabilities, and they are incurred in order to generate revenues. In order for Southwest to fly you, they need to incur costs for the aircraft, for the gas, etc. So when do we record those expenses? We record the expenses when they are used. When we provide the good or service, we incur costs associated with it. That's when we use the expense. Expenses are, again, like the receipt in the cash register. It's just a record of what's been used over time. The expenses can result in assets going down. So I have my cell phone bill, comes in the mail. I've got a record, the invoice of the expense. And then in turn, that may result in my assets, cash, going down when I pay the bill. Or if I don't pay it right away, my liabilities go up because I owe it. So expenses, again, are not synonymous with assets or liabilities. They impact them. The expense is simply a record of what's been used up over time, and that in turn results in assets going down or liabilities going up. Gains and losses are new terms that we haven't discussed. Gains are basically like revenues, and losses are like our expenses. They have the same debit-credit rules, and they affect income in the same way. Gains increase income like revenues. Losses decrease income like expenses. Gains and losses are the result of peripheral activities, which is a fancy way of saying activities that are not part of the normal business operations. So, for example, at UNH is not in the business of buying and selling assets, but at times they need to do that in order to keep the business going. So at times they'll sell old computer equipment and buy new computer equipment. When they sell the computer equipment, they may have a gain or loss that results, which means if we sell it for more than our cost, we have a gain. If we sell it for less, we have a loss. Those gains and losses are not the result of the normal business operations of UNH, and we don't want to let the users think that they can occur all the time. For example, if UNH gets $1 million from selling land, they can never sell that land again. That's not what they're in the business to do. So we want to make sure we segregate that gain away from the other revenues to let the users know that this did happen. We did get a gain. It did have a positive impact on income, but it's not something that's part of our normal day-to-day operations. So let's take a look at Chipotle's income statement. You can see we have revenues and expenses on here, but then we have it broken up into operating activities and peripheral activities. This is what we call a multi-step income statement. And generally, the multi-step income statement is going to look like this. It's a little different for Chipotle because they're really providing a service rather than goods. But we're going to start with revenue. And then we're going to take away cost of goods sold, which you may remember is the cost of the inventory we provide to our customers. And that gets us what's called gross profit. Chipotle doesn't track their gross profit separately, but many retailers would. Then we take out our operating expenses, which is basically any expense related to the day-to-day operations. That gives us what's called operating income. Then we add or subtract other items, which would be our peripheral activities, to get pre-tax income. Then we take out taxes, because the government has to take a piece of the pie, to get our net income. So it's still revenues minus expenses, but we have more subtotals to provide the users with more useful information. So we have gross profit. That's the markup on our goods. So when Walmart sells you an iPhone for $1,000, they didn't pay $1,000 for it. They paid, say, $800 to Apple. So their markup is their gross profit. Then we have operating expenses, which relate to day-to-day operations. And there's no point in memorizing a big list of operating expenses. Instead, we'll focus on the other items. If it's not one of the other peripheral activity items, then it's an operating expense. The reason we want to get operating income and not include those other items is because operating income is what we could expect to happen in the future again and again. The other items, like selling the land, it may be a one-time event and may not ever happen again. So what would be included in other items? Other items would include interest, income, which results from just having money invested. Same with dividend income, results from having money invested. Interest expense results from borrowing money, and then those gains and losses we just talked about. So those are the items, those 5 items belong in the other section, and then every other expense would be considered operating. Again, we segregate the other items because those items may or may not occur again in the future. They're not part of the normal day-to-day operations of the business. So again, our operating revenues relate to the operations of the business. It's from the sale or goods of rendering services as the central focus of the business. It's a fancy way of saying when Chipotle sells burritos, it's earned revenue. That's one of the main functions of Chipotle, selling food. So whenever they sell the food, they're earning the revenue, and it would be considered an operating revenue. And again, a revenue is anything that results in increase in our assets or settlement of liabilities. What would be a settlement of liabilities for Chipotle? Well, if Chipotle sells gift cards, they get the cash up front, but they don't earn it until they actually give the customer food when they turn in the gift card. So when they provide the goods and the customer pays with the gift card, Chipotle now owes less to that customer, so their liability would go down. And we'll go through several examples of that later on. Operating expenses are the outflows that result from generating those revenues during the period. So for Chipotle, it would be like the cost of their employees, the depreciation, which is the expensing of our long-term assets, like all the restaurant equipment, the cost of the food, etc. So all of those would be operating expenses, and those are going to decrease our assets when we pay for them or increase our liabilities if we don't pay for them right away because we'll owe more money. Don't confuse the word expenditures and expenses. An expenditure is any outflow of cash, whether it be for buying equipment, paying a loan, or paying employees and wages. So not all expenditures are expenses. When you buy equipment, that's not an expense. When you use up the equipment and record depreciation, that would be an expense. When you pay off a loan, that's not an expense, but paying interest is. So you have to understand that expenses are when we use up our assets, when we use things up. So again, cash expenditures could result in like debt payments or asset purchases or actual expenses. So they're not synonymous. Some Examples of Chipotle's operating expenses would be repairs expense, utilities expense, insurance expense, rent expense, wage expense, supplies expense, and then depreciation expense. Depreciation expense, remember, is the systematic expensing of an asset over time. We'll cover that more in Chapter 8, I believe. So for now, just understand that when I buy a piece of equipment, it lasts for several years. We got to allocate the cost of that equipment over the years that we're going to use it, and that's what depreciation represents. The other income statement items, these are the items that are peripheral to the business, are interest and dividend revenue, interest expense, gains, and losses. Those are the 5 items that I mentioned before. And then income tax expense also shows up separately on the income statement because we need to know what our pre-tax income is before we can calculate that income tax expense, which is usually based as a percentage of our income. Corporations are required to disclose their earnings per share on the income statement and in the notes to the financials. Earnings per share basically lets investors know how much the company is able to generate in profit for each share of the stock that's outstanding for the business. It's really just a good measure of profitability for the business that investors can compare from one company to the next. Data analytics is hugely important in all types of businesses, and it's no different in accounting. Data analytics, you may have heard that term before, uses big data, so all the types of information that companies gather in order to make decisions. So all sorts of information is gathered when somebody makes a purchase. In the point of sale terminals and information systems related to accounting, inventory, scheduling, marketing, and more, when you click on a link on Facebook, all of a sudden your ads are now targeted to things you're interested in. So various companies use big data and data analytics to help improve their overall business. McDonald's uses data to predict customer demand in drive-through sales. Wendy uses big data to identify the most profitable new restaurant locations. Pizza Hut uses software to track customers' eye movements on digital interactive menus in some of its restaurants to discover what customers subconsciously want. So there's all sorts of ways that companies are gathering data about you and then utilizing data analytics to interpret that data and make better business decisions. So we'll be talking about data analytics from time to time throughout the course, and it's important that you understand that data analytics is extremely important in making business decisions because there's so much data out there that's available. Because with technology, it's very easy to track and gather data. And we want to be able to make sense of that data so we can make better business decisions.